to talk about really is how we modernise community finance. And therefore, to do that, what I want to try and do quickly is try to explain what causes financial exclusion and consumer detriment, but also what explains the sort of limited impact so far of alternative lenders, particularly community lenders like credit unions and CDFIs. Then I want to talk about what can be done and how can we help community lenders take advantage of the new opportunities and challenges in the world. And then if we have time, I'll go into a case study on the London Mutual Credit Union product that we actually evaluated, the CUOK product. Now, if we don't have time for this case study, I think we're doing a workshop later on, and maybe we can actually develop that case study there if we don't get time to go through it now. Now, before I do say anything, I've got to make a disclaimer. Some of you will know that I'm on the board of the Financial Conduct Authority, but what I say today is not FCA policy, and I won't be answering any questions about the FCA policy either. If you have any sort of gripes or if you're angry about the FCA, speak to them. I don't have time to do that at the moment. Okay, so let me talk about what causes exclusion and what explains the limited success of community lenders so far. And I think really, if you're going to fix a problem, then you have to understand why the problem happened in the first place. And at the Financial Inclusion Centre, we kind of attribute that failure to sort of three broad sets of categories. There's external factors, then there's sort of supply side market factors, and then there are actually demand side factors, consumer behaviour or household behaviour. I think we've already discussed this morning that there are a range of external factors like income inequality, asset inequality. The changing labour market in the UK is another big problem that nobody really talks about. The massive growth in non-standard employment. All that is combining really to create sort of massive economic insecurity and uncertainty amongst households. And then we have the austerity measures as well. And as people know, the worst is yet to come with the austerity measures. But I think also on the supply side factors, what's happening is I don't think we really understand just how much trouble the big banks are in at the moment. A lot of their business models are actually the pre-crisis business models were predicated on returns on equity of maybe 20% or 22% or whatever. Those returns on equity are no longer available for mainstream financial providers. Therefore, they're all migrating upstream to try and cannibalise the shrinking number of households that can afford to use their mainstream products and services. But I think another major supply side problem or sort of market problem was that up until recently there was basically unconstrained growth in the payday lending market as well, and that was for a number of reasons, but I mean basically it was unchecked. And if you want to look at if you want to look at the best analysis of the payday lending market, look at our website where we actually analysed there was a report myself and Sarah Beddoes which actually analysed the payday lending business market or business model. It exposed the truth of the business model and demonstrated that actually all the consumer detriment from payday lending wasn't a sort of an unintended consequence or a side effect. The actual detriment was actually embedded into the business model, and that model couldn't succeed unless they were constantly ripping people off and rolling over borrowers. So that was the thing that actually really exposed the business model for payday. But I think also, we have to mention the regulatory philosophy and the regulatory failures as well. I'm not going to answer questions on the FCA, but I'll criticise the old regulatory regime quite easily. I think what happened was that there was a series of macro and micro regulatory failures. And what I mean by macro and micro, that means quite simply, the central banks and the sort of the macro-prudential regulators failed to understand the connection between credit creation in the economy and then financial exclusion and over-indebtedness. They assumed that the market would actually find the equilibrium level and then it would all even itself out over time. So they failed to see the connection between macro policy and micro regulation policy as well. Now this allowed the creation of too much debt, and over-indebtedness and so on. But also, as I mentioned, there was unconstrained growth in payday lending for a very simple reason. The regulators and the policymakers and government really believed that this is market forces. They believed that consumers wanted payday lending, and therefore nothing should be sort of put in between consumer and the marketplace. So that was a philosophical failure as well. Actually, probably more on the part of the Labour Party actually than the Conservative Party, to be frank, because it's Conservatives who actually brought in the cap on payday lending. So anyway, so that's the sort of the supply side and regulatory figures. Then on the demand side, of course, what happened was there was a sort of culture of credit emerged in the UK over the years. We've seen the savings ratio drop to historically low levels. We already have low levels of financial capability and awareness of the alternatives and so on. But I think the last thing I would mention that explains the causes and the continued chronic financial exclusion and underprovision in the UK is I think civil society has to take its own share of the blame as well. I think, this will sound sort of heretical, sort of speaking in one of the most prestigious universities in the land, but I think there's too much self-serving, duplicative research underway. Loads of research papers put out about who's excluded, why they're excluded, and so on. We don't need any more research to tell us who's excluded or why they're excluded. What there hasn't been done is enough research on the alternatives and workable solutions as well. But that's where the money should be going, into alternative, viable solutions as well. Now, I think what we also failed to do really as a civil society movement is we became far too attached to the theatre of protest. And we weren't interested in actually, making sort of rational cases for reform. And quite often, as you see over the past 3 decades or so, sometimes high-profile campaigns work, but high-profile campaigns work much better if they're backed up by robust policy research and by well-costed economic analysis of problems and well-costed alternative solutions. As I say, I know from experience now that if you're a policymaker or a regulator, you will not take a risk on changing things in the market unless there is compelling evidence that allows you to do so. It is a very, very brutal fact of life that the financial services industry, the more resources that we have, they will always use the threat of judicial review to actually stop the regulators from doing something. So unless you can actually support your campaigns with robust analysis, you will not persuade policymakers to change their mind. Okay, so what can be done quickly then? I think what's happening is that those external factors that I spoke about are not improving. We spent the entire Parliament with base rates of 0.5%, but we didn't see any meaningful improvement in the financial exclusion data. And indeed, there's actually some deterioration. Now, the difference is now, of course, is that actually the consumer credit regulations and the clampdown on payday lending actually clears space for alternative lenders, for community lenders. This is the first time they have such an opportunity if they can actually take advantage of that. But there's 2 things we can do. There's only 2 real solutions to these problems, either state provision and state mandated, or else you try and create alternative providers and alternative products. I would still argue we still need American-style Community Reinvestment Act or HMDA-style legislation. I think David mentioned sort of the role of the banks and sort of the theory of penance and contrition. At the moment, the theory goes in those contrition, confession, penance, and absolution. We're a long way from the banks having paid enough penance to actually for all their sins, and that means the public is actually a long way from absolving the banks of their previous sins. So there is more that that the banks can be mandated to do to help vulnerable consumers. But I think as well, there is a lot we can do to promote community lenders, and it comes down to 3 things really. I think it's all about capital, it's all about capacity, and the third thing is all about the economics of distribution and access. Now, capital isn't as much a problem for some of the credit unions who are actually sitting on significant deposits at the moment, but certainly finding new ways of providing long-term capital for the CDFI movement and so on, I think is a big priority. I think capacity is really, really important as well. And Shan mentioned the programme that we're working on with Barclays to try and expand capacity amongst the credit union sector, because there is no point throwing good money after bad unless the credit unions are actually efficient enough to get the money out the door to make them self-sustainable and viable in the long term. But I think there's also other things that they have in the States, for example, like social lending bonds, which can be used to provide long-term sustainable capital for CDFIs and so on. But I think the other point is about how do we improve access and how do we improve the economics of distribution. I think that's where genuine working partnerships with trade unions, charities, and whatever employers, and of course housing associations and debt advice charities, they can reduce the cost of distribution, the cost of access significantly. And unless you can actually reduce the cost of access, then even if you have the best product in the world, the cheapest product in the world, it will sit on the shelf, it will not get to the people who actually need it. So I think I'll really leave that there. Obviously we need more financial innovation and product innovation. I haven't got time to actually go into the evaluation of the London Mutual product, but if anybody comes to the workshop, we will sort of speak in some detail, because that demonstrates if you structure it properly and think about the long term, you can, the not-for-profit sector can develop products and services that people actually need, but more importantly, that people actually want as well, that are designed to meet their needs and preferences. And I'll leave it there. Thanks.